Gold has fallen a little over $100 an ounce since it peaked 3 weeks ago on the back of the highest Middle East tension we'd seen in years. Well, with that tension easing and coming down, so is the gold price, which is now holding major support just over $2,300 an ounce. Meanwhile, the Fed, at the conclusion of their meeting 2 days ago, left the Fed funds rate unchanged, which was expected. What was unexpected was Chairman Powell saying that the Fed had lost confidence in their confidence that inflation was headed towards their 2% target. In addition, we're getting a lot of conflicting data now out of the government and economic statistics. So we've got a lot to unpack in this gold market commentary for Friday, May 3rd, 2024. Let me share my screen. We've lost confidence in our confidence. 6 months ago, Jerome Powell laid the foundation for as many as 6 rate cuts of the federal funds rate in 2024. Well, with the economy being stronger than expected and inflation being stickier than expected over the last several months, that's all changed now. Today, Fed futures rate traders are expecting 1/4 point rate cut from the Fed in 2024, either in September or December. So a lot has changed with this better than expected economy, weaker than expected economy, higher than expected inflation. Let's drill down. We're going to go over gold falling as Middle Eastern tension is eased. US GDP and jobs are easing. Meanwhile, wages, which are inflationary, and inflation are rising. We're going to go over the latest charts for yields, the dollar, gold, and silver. And we've got a great silver bullion special as well. So US GDP for the first quarter of 2024 came in at 1.6%, below what was expected. Meanwhile, inflationary pressures are persisting. And according to Chris Zaccarelli at Independent Advisor Alliance, this report was the worst of both worlds. We also saw Treasury yields jump on the back of weaker GDP, dashing hopes for a Fed pivot. So at 1.6% rate of growth for the first quarter of 2024, this was the slowest rate of growth in almost 2 years for the US economy. You would think that that would help to ease inflation a bit, but inflation has been sticky. As you can see on this consumer price index chart going back to 2000, off to the right there, and highlighted in yellow, you can see the headline CPIs up to 3.5%, up a couple ticks from the last report, and holding above 3%, which is the low, 1 full point to 1.5 full points above the Fed's 2% target. Meanwhile, core CPI inflation is still holding at 3.8%, almost 2 percentage points above where the Fed wants it to be. So inflation is staying sticky. And that's not good. That's what's holding the Fed back and what's confounding the Fed. We've had a lot of talk over the last month of reflation, and perhaps the Fed may have to raise rates. I'm not so sure that's going to happen. I think that we may be seeing a bit of a puff here that may ease in inflation. And I think it's more driven by oil than more people realize. You can see this is a this is a West Texas Intermediate crude chart. It's an oil price chart going back 2 years. And you can see when oil peaked at 122 barrels back in June of 2022, that coincided perfectly with the peak of the CPI headline number at 9.1%. Now, as oil skidded lower following that COVID surge down to $67 a barrel, that's when inflation bottomed at 3% on the CPI. Since then, we've seen the oil price pop back up to 94, back down to 68, back up to 87. Today, it's about $78 a barrel. And the CPI has followed that pretty directly. Now, I suggest that Oil is everywhere in the economy. It's one of the most inflationary or disinflationary factors there is. There should be a bit of a lag between the consumer price index and the price of a barrel of oil, because as the price of oil goes up or down, it takes a month or two for that price increase or decrease to filter through into the economy. But I think that if we watch the price of oil and what's happening with oil, that might give us a pretty good direction, a sense of direction of where inflation might be. Now, remember, both Saudi Arabia and Russia had oil cuts, significant oil cuts earlier in the year to hold the oil price up. And the war in the Ukraine is making matters worse, with the Ukraine attacking one of the major Russian refineries about 2 months ago. So I think as the oil price goes, so may go inflation. So I'm going to be paying a lot of attention to the oil price over the next couple of months to see what happens there. And a weakening U.S. economy will tend to ease the price of oil a bit. But the conflict in the Middle East and the conflict in the Ukraine could make things change a lot very quickly. So that's why we're getting some conflicting data. That's one of the reasons why we're getting some conflicting data. Let's look at jobs. This is a bar chart that shows the creation of jobs on a monthly basis going back to January of 2021. As you can see, over the last 3.5 years or so, that trend has been lower. The April jobs print came in at 175,000 jobs, which was lower than expected. And the prior 2 months were adjusted down 56,000 jobs. The unemployment rate ticked up 0.1% from 3.8 to 3.9%. But what I find interesting here is when you drill down on the statistics, leisure and travel, according to the Bureau of Labor Statistics, said there were only 5,000 leisure and travel jobs created in April. Now, over the last 2 years or so, leisure and travel has been responsible for about 55,000 new jobs every month. And that's one of the factors that would fall off if the economy is indeed weakening. It's been one of the greatest sectors of job growth over the last 2 years, but it's also one of the most sensitive to a stronger or weaker economy. Now, here's where more conflicting data comes in. According to the ADP jobs report, which came out 3 days ago, leisure and hospitality created 56,000 new jobs, which is 51,000 more than the BLS just said today. And you can see on the year-on-year category at almost 700,000 jobs created in leisure and hospitality over the last year. That is the most significant category for job creation. Now, government and healthcare are the other two major job creators in this economy, but leisure and hospitality is the most sensitive to economic growth or weakness. So there's some real conflicting data there. This is some copy I got off of Bloomberg just this afternoon. The economy needs to get its story straight. And this reinforces what I've been saying. On Tuesday, a broad gauge of U.S. labor costs rose by the most in a year, sending yields on 2-year treasuries above 5%. 3 days later, the Labor Department report showed the smallest increase in wages since 2021, sending yields back down. And in the next paragraph shows that retail sales are surging with slowing gross domestic product. Industrial production has been rising while manufacturing has been easing. Jobless claims have been holding steady, yet hiring has trickled down. So we're getting some seesawing of data here, which suggests to me that this economy is transitioning into a weaker phase. So we'll see how this progresses over time. But the Fed's job of raising rates in the sharpest, fastest rate hike cycle we've seen may finally be starting to take effect here. Time will tell. And inflation may tend to ease down a bit. But as I said, the price of oil will have a lot to do with that. let's look at Treasury yields. You can see how they've been rising for all of 2024, and they were rising steadily while the gold price took off as well, which is very unusual because usually in a normal market, gold is extremely sensitive to interest rates. Now, the more that you can get on your money in a T-bill or in a money market, the less attractive gold becomes because gold doesn't produce a yield. Now we've seen yields fall off pretty sharply just in the last couple of trading sessions as we've seen some of the data change. So right now we've got the 10-year Treasury at about 4.52% and the 2-year Treasury at about 4.85%. And they were both about a quarter point higher just earlier in the week. And this is some pretty choppiness in Treasury yields. Let's look at the dollar. The dollar has followed yields as well. And the dollar is stronger primarily due to the interest rate differential here in the US compared to what you can get in other countries. So we're seeing money come from other countries outside of the US into the US to get into our markets, to get into our stock market, our treasuries. Foreigners have to buy the dollar, which buoys the dollar. And that's taken the dollar over 105.50 through April to as high as 106.1, which is a short-term high, as you can see. And it's over what I tagged as major resistance before, but it's still below the previous highs from last fall when the dollar's abnormally strong. But it's fallen off a bit over just the last week's worth of trading sessions. So both falling yields and a falling dollar will help to support gold here as fundamentals start to reassert themselves now that that tension in the Middle East has eased. But remember, that tension in the Middle East could ratchet back up pretty easily at any time. Let's take a look at the gold chart. Here's a 1-year gold chart. And you can see that rally that started at 2040 in the early March. As I've said before, has been one of the strongest solid rallies I've ever seen. Peaked a little over 2,400. Now we've corrected down and we're bouncing at $2,300 an ounce. A good, healthy correction is good for the market. Too much too fast leads to some real big volatility. Gold is holding support at 2,300, which is a pretty major support right here. If it breaks that, it could fall as low as 2,200. I've got support tagged at 2,195 on this chart, where it resisted the rise initially. And if you look at the chart in the bigger picture, you can see that gold has been trading primarily in $100 increments for pretty much the last year. It'll move, bounce between one level and the next, break or above or below, and then trade in a $100 increment, and then again and again. So if gold breaks 2,300, I think support will kick in about 2,250, but we'll see real support at 2,200. Any breakdown in gold from here, I think, is a great buying opportunity. One of the most fundamental drivers of gold over the last 20 years has been higher debt. That's not going to change. We've got major conflict in the world, more than we've seen before. And there's a lot going on that should buoy the gold price. And if the economy does weaken, we'll see yields and the dollar fall and give gold a boost. Let's drill down a little bit to the 6-month chart on the candlesticks. And you can see this reinforces what I've just said. We've got support here at the candlesticks at 2290 and support again at 2195. Gold's been holding on to that support pretty well, but not by much, trading primarily a bit between about 2310 and about 2330. So gold's been in a pretty tight range the last week or so, holding support at 2,300, but I would not be surprised to see gold break down and get into the 2,250 range, maybe test support at 2,200. I would buy that dip. We're heading into the summer months, which tend to be quiet for gold, and then the fall tends to have it very positive impact and perhaps explosive impact for gold. So gold looks a little tentative to me right now. I wouldn't be surprised to see it edge a bit lower, but not by much. Let's take a look at silver. Here's a 1-year silver chart. You can see silver's rally has been really strong, but it's giving up gains now, peaking at about 28.84, trading today at about 26.70. Major support for silver's at 26.25. If we ease below that, we'll hit major support again at $25 an ounce. So I don't think silver has that much liability here should it weaken. Again, it's trading at not quite half of its 2 previous highs. So I think silver is a fantastic buy in the current market, especially if it gets a little bit cheaper. Let's look at the candlesticks, which will again, 6-month candlestick chart will reinforce what I've been saying. We're seeing a lot of support on the candlestick wicks at 26.25, with the primary price trading between about $26.50 and $27 over the last week or so. But again, this chart's looking a bit weak, and I wouldn't be surprised to see silver break 26.25 and test 25. I would look at that as a real buying opportunity if that were to happen. And coincidentally, we've got a great silver special right now. We have sovereign minted 1-ounce silver coins out of South Africa, dated 2023, as low as $2.79 over spot in volume. The South African mint had a pile left over from their 2023 mintage, and one of our trading partners took it. So we've got a great opportunity while supplies last for 2023 silver Krugerrands at a very low price for a sovereign minted 1-ounce silver coin. We are American Gold Exchange. We are a national physical precious mail order dealer out of Austin, Texas. This is how you contact us. We cannot thank our clients enough for the support that you've given us over the last 25 years. Without our clients, we don't have a business, and there's not a day that goes by that we don't remember that. So thank you for your loyalty and your trust. If you like what we're doing, please subscribe to our video, like it, and share it on social media. Any help you can give us that way is greatly appreciated. So thank you so much for your time, and have a great week.